Hello, this lesson, I would like to teach you bank reconciliation. Now, there are two entities involved in this chapter. So you have here, that's me, and I am the owner. And you have another entity called the bank. All right, let's touch it up here. And two entities here. Now there are many transactions that go on in a day, in a week, and in a month. All right, and many of these transactions would be related to bank, right? In my company, okay, that's me here, the owner, I will record all these bank related items in what I call the cash book. And you should know this by now. That's in chapter 6, right? So in cash book, you've learned that you have two kinds of accounts inside. You have cash at bank account, that's the account that we're talking about, all your bank related transactions, and you have the cash in hand account. So these are transactions that you actually use cash. Okay, so the money in your cash register. Now in the bank, all right, they also concurrently prepares a document for you, okay, detailing all the transactions that has happened in the month. All right, and at the end of the month, they will issue you this source document called the bank statement. All right, so the bank statement is a source document prepared by the bank for you. Now you can see that there are two different kinds of information that we have here. We have the cash book, and then we have the bank statement. Now, let's just recap a little. You remember ALIEQE, don't you? Okay, ALIEQE. So we actually have cash book. Okay, which ones of the accounting element does cash book belong to? Okay, it's actually assets, right? So we know that cash at bank or cash in hand, they are both assets to the business. So let's just put here A. Now, we also learned the double entry rule. And here we go. This is the double entry rule. Plus, minus, 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 plus, minus, plus, 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 minus. And assets, the nature is always to debit. So to debit is to plus for cash book. Okay, so it's a little bit messy over there. But anyhow, it's in different colors, so I hope you can see it. Now let's go over to the bank side. Okay, if we look at the bank statement, you would typically see that if you have money in the bank, all right? So I repeat, if you have money in the bank, you will realize that you will see is a credit balance, okay? And credit balance is actually a positive balance to you. Now, why credit balance? Now, it is a matter of perspective. It is a matter of perspective because the money that you have in the bank sees it as a liability, right? The bank uses your money, which is not their money. They're using it for investment purpose and so on, and it's not their money, so they see it as a liability. So in their perspective, they would see it as a credit balance. But from your perspective, you know that if you have money in the bank, you see the bank statement, it is a positive balance to you. All right, so on the flip side, if you realize that, or if you see in some situations or some examples that your cash book becomes a credit balance, then you know that you have gone into an overdraft. Okay, so if you have a negative cash book balance, you have gone into an overdraft. Likewise, if your bank statement shows a debit balance, then you would have gone into an overdraft because right now you would be owing the bank instead. So that's a bank overdraft. All right, already we have talked about this. So now I'm going to bring you, okay, I'm going to erase this part here and I'm going to bring you through why is it that there is even a need for bank reconciliation. Now, realize this, there are certain things that I know and the bank doesn't know, and the bank knows and I don't know. What am I talking about? Now, let me show you this, okay? So I'm going to give you a little bit of a pictorial here. Now, let's say, for instance, I have a trade payable. Okay, let's just draw a lady, okay? So we have a trade payable here. I just label it as trade payable. And you are supposed to pay the trade payable because why? You have bought some goods, some inventory from the trade payable, and now it's time to pay up. So here we go, we issue a check. Okay, so this is a check. You issue it to your trade payable. All right. So in my cash book, I would have already recorded that I have paid the trade payable. Wouldn't you agree with me? I have already paid the trade payable because I have already made the check to the trade payable. However, now this trade payable, he kind of like just left it inside his pocket and he didn't go to the bank to present the check to the bank. Now we have a case of what we call checks not yet presented. Now, because he didn't go to the bank to present it to the bank, would the bank know? Of course not. The bank doesn't know. But for me, the owner, I already know because I have already paid, right? So this is a case of let me just do it in a different color for visual sake. This is a case of I know and the bank doesn't know. Yeah, so let's just do a bubble wrap. Now, so let's go on to the other side. You see over here, what we call this is your trade receivable. Okay, let's just draw a snowman here. Very cute snowman. Now, what does the trade receivable do? Of course, the trade receivable, after having bought goods from you, they owed you then, and now they're gonna pay you. So now I'm gonna pay, and likewise, the trade receivable is gonna pay, and the trade receivable is gonna issue me a check. And same thing, okay? I already have collected the check, but this time round, I put it inside my pocket. Shall we do this? Just put it inside my pocket, and I didn't go to the bank. I did not credit the check in time. Okay, so now this is a case of checks not yet credited, or sometimes they call it not yet deposited. Yeah, so again, it's a case of I know and the bank doesn't know. And by the time the bank knows, it could be a case of a month later or 2 months later or so on, because anyway, the validity of a check is 6 months, right? So we have a long time ahead of us to bang in the check. So it may not coincide with the date that I actually have already recorded the receival of the receipt of the check or the payment of the check. And so I hope you are clear about this part. Now let's move over to the bank side. Now on the bank side, there are also a lot of items that the bank knows and I don't know. All right, so I'm just gonna quickly draw this bubble over here that says bank knows. All right, but I don't know. Okay, so let's bubble it up, and I am going to give you a series of what could be in here. Now let's just say bank charges. Now the bank is going to charge you say $2 for you not keeping a minimum balance of 500 or 1,000 for some banks. Will the bank call you up and tell you, hey, look, I'm going to charge you $2 for bank charges? The bank is not going to do that, because if the bank is going to do that, then the bank will be a very, very, very busy bank. So they're not going to call you up. So if they are not going to do that, then you will only see it in the bank statement when it is released to you. Would you agree with me? So here we have number one, bank charges. And also sometimes, like checkbooks, they are not free, they cost about $10. So the bank again will not call you to tell you that, hey, I'm going to bill you for the checkbook. So they're just going to charge you, and you're going to see it in the bank statement. That's about it. Second, you know that you put money in the bank and they will give you interest income. Likewise, the bank ain't going to call you up to tell you, hey, you have just gotten $1 for interest income because you've put in so much money, in the bank account. So they are not going to do that, because it's just not practical. Yeah. So these things you will only see when the bank statement comes. What other things? Okay, let's just go through the list. Now, what is this? It's called direct payments. Now, what are direct payments? Okay, sometimes we call direct payments another name could be standing order. Okay, standing order, or sometimes we call them direct debits. All right. Oops. Okay, so what are direct payments? Basically, it is like, if you think direct payments, you can think gyro. Like, you tell the bank that every month you can credit, or you can take away this amount, or you can debit this amount from your bank account because you have given the authorization to do so. Okay, what am I talking about? Okay, let's just say your handphone bills. Let's say, for instance, you don't want to go to AXS machine every month to pay up your bills. So what you can do is you can work out a gyro payment. Okay, so you authorize the bank to make regular payments on your behalf to, say, StarHub, M1, or Singtel. Okay, that's direct payment. So it doesn't go through you. Okay, so it basically just goes to the bank. The bank will just take the money out on your behalf. Okay, because you have already given that authorization. All right, don't have enough space here. So now let's go on to number 4. We have also another one is direct deposits. Okay, what are these direct deposits? Direct deposits are like, sometimes we call them credit transfers. Okay, so these are what we also know as bank transfers. Okay, if you have had the chance of transferring money to your friend, that's a bank transfer. Let's say, for example, today I owe A $50. I don't have the money now. I don't have the cash right now. So, but I can go back, or I can go to any ATM machine. Okay, I can go to an ATM machine and I can do a bank transfer to A. Likewise, with technology these days, I can go back and do online banking, and I can do a bank transfer to A. Okay, so this is direct deposit. Lastly, we have another, Lastly, we have wait, hang on a second. Okay, anyway, let's just forget about this line. Lastly, we have another one we call dishonored check. Okay, so dishonored checks is when previously you've put in a certain check. You put in a certain check. Somebody gave you a check of $500, for instance, and then later on in the month you realize that the check is bounced. All right, and the bank will have a record of that, and you may not know it until you see the bank statement. So I have pretty much explained to you that you see here we have cash book, bank statement, and there are items that, some of it is and the bank doesn't know, and some of it is the bank knows and you don't know. Now we need to do something about it, and hereby we talk about this chapter called Bank Reconciliation Chapter. Now I'm just gonna bring you next to the steps involved in doing bank reconciliation. Let me just put it in green. Okay, the step number 1. Once you are, a typical question will give you a cash book as well as a bank statement, which I've already explained in detail what are these two items. Okay, so your step 1 is really to tick similarities. Okay, to tick similarities. Okay, same item, tick it away. Okay, you don't have to do anything about it because they are the same, right? Now, number 2, we have got to circle the differences. All right, circle the differences. Now, number 3, now we have to prepare the updated cash book. Okay, prepare the updated cash book. And what do you look at when you want to prepare the updated cash book? Of course, you would have to look at the bank statement, right? What is in the cash book is already written in your cash book. So you don't have to update your cash book using what is in your cash book. You have to look at the bank statement. So for this one, we will look, okay, this is an I, look at the bank statement for the circled differences. All right. And last but not least, step 4, we will prepare the bank reconciliation statement. Okay, BRS for short. All right. And of course, for the bank reconciliation statement, we are not going to look at what is in the bank statement already. We will be looking at what is in the cash book. Okay, so where is your eye supposed to be looking at? Looking at the cash book, the circled differences. All right, so I will wrap up this part here. The next lesson, you will be hearing from me on how to go about doing it itself.